Hello everyone. Welcome to our channel. Today, we're diving into a crucial topic, especially for those entering the golden years of life, the biggest financial mistakes seniors often make. Have you ever wondered why so many seniors in America, despite working hard their entire lives, face financial struggles that leave them anxious about the future? That's the pain point millions are experiencing, from running out of savings just a few years into retirement, to cutting back on basic expenses, or even falling into debt. These mistakes not only lower quality of life but also impact mental health, making the dream of a peaceful retirement feel out of reach. But don't worry, today's content will help you identify these pitfalls clearly and provide practical solutions to steer clear, ensuring you protect your wealth, enjoy life, and leave a legacy for the next generation. This isn't just knowledge, it's the key to feeling more confident in your financial journey. First, let's take a broad look at the financial landscape for seniors in America. According to reports from the AARP, over 50% of Americans aged 65 and older worry about not having enough money to live comfortably. The biggest reason? Financial mistakes that accumulate over years but only explode in retirement. We often think of old age as a time to relax, but in reality, it's a phase that demands smarter financial management than ever before. With rising inflation, skyrocketing healthcare costs, and longer lifespans, a single misstep can lead to major consequences. Now, let's dive into the first mistake, one that most people fall into without realizing. The first and perhaps most significant mistake is not planning for retirement early or failing to update that plan over time. Many seniors in America only start thinking about retirement in their 50s or 60s, but in reality, planning should begin in your 30s or 40s to harness the power of compound interest. Imagine you have a 401k, a common retirement account in the US, but you don't contribute enough or invest wisely. The result? When you retire, you're left with a small nest egg, insufficient to combat inflation. According to the Federal Reserve, the average American saves only about $88,000 for retirement, while the cost of living post-retirement can reach $1 million if you live 20 to 30 years. The pain here? You might have to work extra years, sell your home, or rely on your children, losing the independence you deserve. To avoid this, start by calculating your retirement needs today. Use online tools like the retirement calculators on Fidelity or Vanguard's websites. Contribute the maximum to your 401k or IRA, individual retirement account. And remember, if you're over 50, you can make catch-up contributions of up to $7,500 annually. Also, diversify your investment portfolio to reduce risk. Moving to the next mistake, we see that even with a plan, many still falter in daily money management. Following the planning issue, the second common mistake is withdrawing money from retirement accounts too early or excessively, leading to heavy tax penalties and depleted resources. In the U.S., withdrawing from a 401k or traditional IRA before age 59.5 incurs a 10% penalty plus income taxes. Yet, many seniors, especially those facing unexpected health issues, do this without careful calculation. For example, a 62-year-old withdrawing $50,000 to renovate their home could lose an additional $5,000 in penalties and thousands more in taxes, significantly shrinking their remaining funds. The bigger pain? When retirement savings run dry, you're left relying on Social Security, which averages just $1,800 a month, often not enough for healthcare or travel. The solution? Wait until the required age to withdraw without penalties and consider a Roth conversion to shift to a Roth IRA, where withdrawals are tax-free. Also, build a separate emergency fund covering 3 to 6 months of expenses to avoid touching retirement savings. From here, we shift to an investment-related mistake where ignorance can make wealth vanish. Another major financial mistake seniors in America make is failing to diversify their investment portfolio, leading to high risk and significant losses when markets fluctuate. Many keep all their savings in low-interest bank accounts or invest everything in stocks of a familiar company like Apple or Amazon, neglecting bonds, ETFs, or real estate. The result? When markets crash, like in 2008 or 2022, they lose tens of percent of their portfolio's value. According to Morningstar, those who don't diversify risk losing 20 to 30% of assets during a crisis, compared to just 5 to 10% for a balanced portfolio. The pain? You may have to cut back on lifestyle, abandon dream vacations, or sell assets at a loss. To fix this, follow the 100-age rule. For example, if you're 70, invest 30% in stocks and 70% in safer bonds. Use robo-advisors like Betterment for automatic diversification and rebalance your portfolio annually. Moving on, we can't ignore external risks, especially financial scams. Next, a common and dangerous mistake is falling prey to financial scams, with seniors in America being the primary targets. According to the SEC, over 5 million scams target those over 60 annually, causing losses up to $3 billion. These come as fake IRS calls, emails promising high-return investments, or even scams from supposed acquaintances. The pain isn't just financial loss, it's the loss of trust and mental health, leading to depression or isolation. A classic example is the grandparent scam, where fraudsters pose as a grandchild in distress needing urgent money. To avoid this, always verify information through official channels, never share personal details over the phone, and use anti-scam software like Norton. Joining community groups like AARP to learn warning signs is also key. From scam risks, we move to a more internal mistake, neglecting estate planning. Another significant mistake is ignoring or failing to update an estate plan, leading to family disputes and asset loss due to taxes. In the U.S., without a will or trust, assets follow intestate laws, which may not align with your wishes and can incur estate taxes up to 40%. Many seniors think, "I'm still healthy, I don't need this yet," but unexpected events like accidents or illness can strike any time. According to the American Bar Association, only 45% of those over 55 have a valid will. The pain. Family conflicts, fragmented assets, or losses to taxes, reducing the legacy you want to leave. The solution: meet with an attorney to create a will, living trust, and designate a healthcare proxy. Update them every 5 years or after major events like a divorce. Use tools like LegalZoom to start, but verify with an expert. Next, we address healthcare costs, a field where mistakes can devour savings. The next mistake is not preparing for sky-high healthcare costs, especially in America's expensive system. Medicare, the health insurance program for those over 65, covers only about 80% of costs, leaving the rest to you. Many seniors skip supplemental insurance, Medigap, or long-term care insurance, facing bills of hundreds of thousands for care like nursing homes. According to the U.S. Department of Health and Human Services, the average person needs $100,000 for post-retirement health care. The pain. Selling your home or taking loans to pay bills, undermining financial independence. To avoid this, enroll in Medigap within the first 6 months of Medicare eligibility and consider long-term care insurance from your 50s. Save separately for health care via an HSA, health savings account, if still working. From healthcare, we move to an income-related mistake, not optimizing Social Security. A common financial mistake is claiming Social Security too early, leading to permanently reduced benefits. In the U.S., you can claim from age 62, but waiting until 70 increases benefits by 8% annually. Many claim early for immediate cash, but this can mean 30% less than the maximum. According to the Social Security Administration, early claimants lose $100,000 in lifetime benefits on average. The pain. Lower income, forcing lifestyle cuts or extra work. The solution: calculate your break-even point using SSA.gov tools, and if you're in good health, wait until 70. Coordinate with your spouse, like one claiming early and the other waiting, to optimize. From here, we address debt, a heavy burden. Next, carrying too much debt into old age, from mortgages to credit cards, is a major mistake. High interest rates erode fixed retirement income. According to the Federal Reserve, 40% of those over 65 have an average mortgage debt of $100,000. The pain. Financial stress, reduced ability to travel, or help grandchildren. To fix this, prioritize paying off high-interest debt first, refinance mortgages if rates are lower, and avoid new loans. Use the snowball strategy to pay debts gradually. From debt, we turn to inflation, the silent enemy. Another mistake is ignoring inflation's impact on savings. In the U.S., inflation averages 3% annually, meaning $100,000 today is worth only $74,000 in 10 years. Many seniors keep cash or overly safe investments, failing to keep up with inflation. The result: reduced purchasing power and lower quality of life. The solution: invest in inflation-resistant assets like stocks, real estate, or TIPS, Treasury inflation-protected securities. Track the CPI and adjust your budget yearly. Next, we address the lack of continuous financial learning. Finally, not staying updated on financial knowledge leads to poor decisions. The financial world evolves fast, from new tax laws to digital investment tools. Many seniors hesitate, thinking, "I'm too old to learn." But AARP data shows those who keep learning have 20% higher assets. The pain. Missing opportunities, like not knowing about Roth IRA conversions. The solution. Read books like The Simple Path to Wealth by J.L. Collins, take courses on Coursera, or follow channels like ours. Join community groups for discussions. In summary, these mistakes aren't inevitable. You can avoid them with action today. Start by assessing your financial situation, planning, and seeking advice from a trusted CFP, Certified Financial Planner. Remember, old age is for enjoying, not worrying. By recognizing and correcting these pitfalls, you protect yourself and pass on lessons to the next generation. Thank you for watching until the end. We'd love to hear your thoughts. Please leave a comment below sharing one thing you learned today and how you plan to apply it in your life. Your thoughts matter to us, so don't hesitate to share. Reading your comments gives us motivation and encouragement. If you liked this video and found it helpful, please like, subscribe, and share. Your support helps us keep creating valuable content to inform and inspire you. Thank you for watching, and we look forward to seeing you in the next video.